Hello, everybody. Welcome to Accounting Superstars. This is Professor Don Bush. I've been a professor for about 30 years and a CPA for about that long, and I've got fantastic ways to teach accounting, ways that you'll understand. And today we're going to study operating leases. Once again, this is example number 2. Now, if I go too fast in example number 2 or leave things out, go back and watch example number 1. I kind of take that one a little bit slow. It's very, very similar. And so why are we doing this? Well, accounting for operating leases is brand new. They've got brand new rules that they're implementing as we speak. And what's happening here is in the past, companies could structure leases in such a way that it appeared that they were just renting assets. And as a result, they could keep the assets and related liabilities off the balance sheet. And what that does is if you can keep assets and liabilities off your balance sheet, it can make your return on asset ratio look better, your return on, your asset turnover, return on assets, those ratios will look better. And your debt to equity ratio will look better. So companies did everything they could to avoid keeping assets and liabilities on their balance sheets. The Accounting Standards Board thought it would be best to make financial statements comparable among companies. So companies that own a lot of assets and have a lot of liabilities would be a little more comparable with companies that are leasing assets and have those lease liabilities. So everything's going on the balance sheet, folks, pretty much, with just very few exceptions. So here we go. So we're going to study operating leases from the point of view of the lessee. We've got when we get to a construction, they're going to lease a big, giant dump truck. Beautiful dump truck here. When we get to a construction is leasing a truck from Tough Trucks. 1.2, the lease agreement begins on January 1st, 2001. And 1.3, the truck is not of a specialized nature. What does that mean? What does specialized nature mean? Well, it means that this truck was not built and designed specifically for when we get to a construction and would do no one else any good. This truck would do a lot of construction companies good. A lot of construction companies would like to own or lease this truck. So it's not of a specialized nature. 1.4, the lease is non-cancelable. When we get to a construction, can't just turn the truck back in and say, hey, we're done. The lease term is 3 years right here. And by the way, it's a good idea to organize your information. I know when you're reading these problems in the textbook, they usually describe things in paragraph form, and it's hard to keep the information straight and know what relates to what. And so I always take the time just to spell it out. It's time well spent. Also, if you're doing this in Excel, which I highly recommend, you can organize all your numbers. So that way you can find your numbers quick and easy, and that way you can just copy and paste. And so here we go. The truck's fair value at the beginning of the lease is $100,000. So this truck sitting right here would cost on the fair market $100,000. 1.7, the truck's economic life in years is 8 more years. That includes the 3 years of the lease. So grand total, this truck should last another 8 years. 1.8, the estimated salvage value at the end of the lease is unguaranteed at the end of 3 years. Now I wrote this in red here, bold red, because I wanted it to stand out. You have to keep it straight. Is it unguaranteed or guaranteed? It makes a world of difference in leasing. And in this case, it is unguaranteed. And so at the end of the lease, this truck should be worth about $55,000. When we get to a construction is not guaranteeing that, but that's what is estimated. 1.9, no lease renewal options. When we get to a construction, we'll not own the truck. When the lease is over, it is over. 1.10, when we get to its incremental borrowing rate for a collateralized loan is 5%. And I wrote here collateralized loan on purpose because in the past, people would use a borrowing rate that was really high, say their credit card borrowing rate of 20% or 29% for a Home Depot card if you're late on your payment. I'm not late on my payment, so I just know it's 29% if you are late on your payment. So when we get to an incremental borrowing rate for a collateralized loan, so a collateralized loan means that there's an asset pledged. If you don't pay back the loan, the lender gets your asset, which results in a lower interest rate. So the accounting profession said, we want you to use a lower interest rate because that will give us a higher present value of the minimum lease payments, and more on that later. 1.11, lease payments are made annually beginning December 31st, 2001, end of year. And I did this on purpose because I wanted to make this example as simple as possible. Payments at the end of the year are very uncommon. It's more common to have the lease payments due at the beginning of the year. If you're renting an apartment, think about when the rent is due. 1.12, amount of first lease payment is $17,000, but 1.13 says lease payments increase each year by inflation, 3%. So each year the payments are going to go up. So this puts a little wrinkle in our problem here, but we'll figure it out. So coming down the page here, step number 2. Schedule of cash payments each year increases by 3%. So year 1, we've got $17,000. If you increase it by 3%, you get year 2, and increase that by 3%, you get year 3. Grand total $52,545. And what we have here is the average payment. So if you take $52,545 divided by 3, you get $17,515. And apparently the people that made up these accounting rules, these new accounting rules, they wanted operating leases to have an even expense amount. I'm not sure why they did, but that's what they did. And so we are actually going to use this average payment here. So coming down the list here, so step number 3, calculate the present value of the 3 cash payments. Now use the average cash payment. I've got here in bright red so you don't get mixed up. So we're going to just use the average here, 17,515 for each of the years. And we're going to find the present value. Now if you're not very up on Excel, this is a good time to get started. Excel is a wonderful program. You need to use it, folks, especially if you're in business or accounting. So I wrote down here some notes. Excel formulas, financial NPV, 5% interest, and so you can use that to help figure out what to do. So what you do is you go up here to formulas, and you go to financial, and you come down here to NPV. NPV, there you are. And if the print is a little too small to read on your screen, I'll read it too. So the first line here is rate. What's the interest rate? So you got to go find the interest rate, and it's up here. If we look in the information, that's why I like doing this. The interest rate we're going to use is 5%, so you just click on it. There you go. Value number 1, coming down to value number 1. Here we go. We go down here. Make sure you get the right thing. Here's our first payment, so value number 1. Value number 2 is the second payment. Value number 3 is the third payment. And all you have to do is say OK, and you will get the answer. Now, I've already found the answer, so I'm going to just cancel out of this so I don't mess things up. So here's the present value, $47,698. So, ladies and gentlemen, here we go. Step number 4. Step number 4, it doesn't apply to this problem too much, but I want to get you into the habit of thinking about this because it's very important, and it's used to calculate the capitalized amount here. And you need to know these. So create a list of the minimum lease payments. Minimum lease payments include the following. There are 4 things it includes. The rental payments, excluding executory costs. And I made a note here, they're increasing each year. I just put the first payment there. And we're going to use it to figure out the capitalization amount. Bargain purchase option. There's no bargain purchase option. When we get to construction, we'll not be able to purchase that truck for $1 or some ridiculously low price that they could not refuse. Guaranteed residual value. Now it says guaranteed residual value, exclude unguaranteed. Now, if you recall, up in the information here, the residual value is unguaranteed. That's why I put it in red here, unguaranteed. So if it's unguaranteed, we do not include it. We only include guaranteed residual value. Penalty for failure to renew lease. Well, they're not going to renew the lease, and there's no penalty for failure to renew the lease. So there you go. So coming down to the next box, I know there's a lot of information here, but I'm trying to do this very systematically for you, so that way you can get in the habit of doing it in this process. So that way you don't leave anything out and it's not confusing. So I know we haven't started doing journal entries or any of that yet, but we have to get all of our ducks in a row, as they say. So in step 5, what we're doing is we're determining if it's an operating lease or a financing lease. And here's how it works. We've got 5 tests. And if any of the tests end up being yes, then it's a financing lease. Now you can see I wrote no in all the as a result, but let's go through them. So test number 1, transfer of ownership. Is the truck going to belong to when we get to construction at the end of the lease? The answer is no. Test number 2, is there a bargain purchase option at the end of the lease? Can they buy the truck for $1? No. The lease period is 75% of the economic life, 75% or greater of the economic life. Well, they're going to lease the truck for 3 years. The economic life is 8 years. If you do a little division, you get 38%, and 38% is less than 75%, so the answer is no. Present value of the lease payments. Well, here's the minimum lease payments, folks. Present value of lease payments, $47,698. Where'd we find that? It's right up here. There it is. We figured it out. It's right there. So the present value of these lease payments. So coming down here, $47,698. The fair market value of the truck is $100,000. That is, on the free market, that truck would sell for $100,000 today. So the present value, the present value lease payments divided by the fair market value is 48%, which is less than 90%. So the answer is no. If this 48% would have been greater than 90% or greater, then we would have said yes. But the answer is no. Specialized use, we talked about that. That truck is simply a truck. It's not specially built for when we get to a construction. So the conclusion, since we answered no to all these, the conclusion is it's an operating lease. So what an operating lease means is when we get to a construction is not buying the truck, but they do have to include the asset and related liability on their balance sheet. That's what the new rules are about. So here we go, the last step here to get ready, and we have to build an operating lease amortization table. And we have to be real careful here because this has got to be correct. And one way you can know if you're correct is if it ends up 0 in the bottom right hand corner or very close to 0. Maybe you might be a couple pennies off or maybe even a couple dollars off. But if you're $50 off, $100 off, $1,000 off, $50,000 off, you did it wrong or you made a mistake. So here's how it all starts out, folks. It starts here on January 1st, 2001. The beginning balance of this lease liability is $47,698. Now, how did I know that? Well, that's the present value of the lease payments. We found it right here, step number 3. Present value, $47,698. So here we go. So here's the first line, 12/31/2001. So this is the very end of the very first year. The cash payment is going to be $17,000, and we can get that number off of our lease payments. Let's go back up there. Here's our lease payments right here, $17,000, $17,510, $18,035. There's our lease payments. And by the way, since we're here, here is our average. Remember, we took an average, $17,515, and figured out the average right there. So coming back down to the amortization table. So in the first one, we put our actual cash payments. There they are, actual cash payments. The lease expense is going to be the average, and I wrote it in bright red here, average. And 5% of the interest on the liability, well, the liability starts out at $47,698. If you multiply that by 5%, which is the incremental borrowing rate, that's up in the information, you get $2,385. And so to reduce the lease liability, what you do is you take column B, I've got a note here, B minus C, so you take column B minus column C, and you get column D. And to get this next number, 32,568, all you do is you go 47,698, the previous number, minus the amount that we are reducing the liability by, and you get 32,568. So you do this for each and every line, same deal, and you should end up with 0. And if you don't end up with 0 or something very close to 0, like if you're only pennies off, that's okay. But you need to end up very close to 0, otherwise you did this wrong, and everything else from this point on will be wrong. So you need to make sure this is correct at this point. So coming down here are the journal entries. I'm going to split the screen so we can see the journal entries a little bit better. So here's the first journal entry, folks. Recording the lease of the truck. So on January 1st, 2001, so look at this, it's the beginning balance, 47,698, 47,698. So we're calling it right of use asset. We are not debiting truck or equipment or property, plant, and equipment. It's right of use asset. And to me, that sounds like an intangible asset. We'll have to see how this plays out as people do their accounting here in the next couple of years. But right of use asset is what we debit. Lease liability is credited for the exact same amount. So at the end of the first year, 12/31/01, we're going to use these numbers right along in here to make a journal entry. So here we go. Here's what the journal entry looks like. Lease expense is going to be $17,515. Where'd that number come from? Right there, folks. I've got it listed. Lease expense. Lease liability is being decreased. It's being debited by $15,130. Where's that number coming from? Right there. And we're spending cash, $17,000. There you go. And right of use asset, I've written here plug. So you just write in whatever it takes to make this journal entry balance, and it miraculously all works out in the end. So this is a plug. If you don't know what a plug is, what you do is you add up your debits, subtract away your credit, and whatever's left is the plug. So there we go. There's our first entry. So let's go down to the second year. Here's the second year. So 12/31/2002, here are the numbers we're going to use, folks. We're just going to use these numbers to make the journal entry. Lease expense, there we go, same place. Lease liability, we're reducing the liability by $15,887. Cash, $17,510. There you go, getting it from there. Right of use asset, well, it's a plug, whatever it takes to make this journal entry balance. That's what you use. Coming down to the last year. Here we are for the last year, 2003. We're going to use these numbers right along here, folks. The lease expense is coming from there. The lease liability, the reduction in the lease, it's coming from right here. And cash, $18,035. And the right of use asset is being decreased as a plug. All you're doing is add up your debits, subtract away your credit, whatever's left over. There you go. Now, when I worked through this problem, I wasn't sure if I did it right. I thought I was, but I wasn't sure. So what I did is I made a couple of T accounts. And that way I could check my work. So what I did with each of the journal entries that affected the right to use asset or the lease liability, I posted them. So here was that beginning balance, and I posted every time I credited right of use asset, I put it right in here. Lease liability started out 47,698, and every time I debited lease liability, I wrote it down here. And I wanted to make sure that by the end of the lease, it equaled 0 and 0, and it did. And so that told me that I probably did this problem correctly and I didn't make any mistakes. So, because this problem's a little complicated. So, folks, what did we learn today? We learned how to account for operating leases from the lessee's point of view. And we looked at the new rules. They're kind of wild. They're much more complex than the old rules. Now, if your textbook doesn't look like what we just did here today, then you probably have an old textbook, which is okay because most of the other lease rules are the same as before. It's just these operating leases for the lessees that are significantly different. So, ladies and gentlemen, I hope this helped. I hope you enjoyed the lesson, and hit that like button. And until next time, over and out.